Hello, everybody. I am Rick Reedy. I am a BU trustee and chair of the Advisory Committee on Socially Responsible Investing. And welcome to our panel discussion tonight. I'm going to actually have our moderator introduce the panelist. And I want to start off with a few things. Just to remind everybody what our committee does. It's a group of students, faculty, and trustees, and it's our responsibility to evaluate, in this particular case, what we're talking about tonight, a petition set forth by a couple of student groups as well as the faculty group to decide what we should do with respect to the issue of investing, divesting in this case, fossil fuels. And the group has met several times, and tonight is our fifth forum. And beginning today, we're actually beginning deliberations to specifically respond to the petitions and make some recommendations to the BU trustees. Just one last comment I'll make, because I know it might come up, and I might as well answer it while I'm up here, is really what is our process from here on to come to a resolution on this. So the next full BU trustee meeting is in April. And what our committee is going to do over the coming weeks is get together to the best that we can and come to some sort of collective recommendation and bring that forward through. First, we bring it to the chair of the trustees. Then he decides whether to bring it through what's called the executive committee, which is a subset of the trustees that meets more regularly, but then eventually to the full board. It's my hope that we'll get through this process, and I know we'll have some discussion on it at the April trustee meeting, but it's also my hope and desire to actually bring forward some sort of proposal or specific proposal from the committee for the April meeting. What actually happens at that meeting? I know there'll be lots of discussion. What actually happens on that would be total speculation on my part right now, but that's the current situation. Okay? And with that, I'm going to introduce, we have this great panelist tonight. We're specifically going to talk about all the things that BU can do with respect to the fossil fuel industry, divestment being one of them, and just go back and forth on what those options are and get input from you. I'd like to introduce a gentleman who I guess started in radio in Colorado and worked his way up through the broadcast industry.
Television without picture.
Television, okay. The script I got that I memorized said radio. Anyway, and then he eventually came to Boston and was a very prominent local news anchor for, I can remember Channel 7, I don't remember what.
Channel 7 and New England Cable News.
New England Cable News. And now a distinguished professor at BU in comm. I'd like to introduce everybody to R.D. Sahl. R.D., thank you.
Rick, thank you very much. Good evening, everybody. Thanks, first of all, for the update on the process that the committee is going through, and we appreciate, I think, students and faculty alike that you're taking a good, hard look at this subject. As Rick noted, this is the fifth in a series of forums that have talked sort of around the issue of divestment. We've talked about climate change and sustainability and a couple of other topics. And tonight we want to talk very specifically about the divestment of fossil fuel stocks and companies. Divestment, it seems to me, is part of a larger concept that comes with lots of names. It's sometimes called green investing, impact investing, values-based investing, socially responsible investing. And proponents of divestment argue in part that endowment investment should reflect values. In this case, the moral imperative to get off fossil fuels and save the planet. Skeptics argue in part that divestment doesn't have much impact on the fossil fuel industry and that there are other ways to affect behavior. Those are the kinds of issues that the committee is grappling with and that some of you have reached conclusions on already, and that there is still a lot of discussion, as we'll find this evening. Our goal tonight is to take a larger look at all of this and a drill down, although I'm not wild about that expression, but for obvious reasons, about how this process works, what the alternatives might be. And our plan is to go about an hour till about 8 o'clock and then open it up to your questions. And rather than the traditional handing around the microphone, we're going to try a little high-tech action tonight with something called Poll Everywhere. So I think you've been passing out slips of paper that explain that. If you text BUDOS, BUDOS, to 22333, or use www.pollev.com/BUDOS, or install the Poll Everywhere app, I'll see the questions up here and we'll sort through them and get into our conversation. Let's meet our panelists, starting at the end, your left. Tim Smith is Senior Vice President and Director of Environmental, Social, and Governance Shareowner Engagement. How do you fit all that on a calling card, by the way? At Boston-based Walden Asset Management. Tim has been working in this field of socially responsible investing, sustainable and responsible investing for 40 years. The goal, as he's explained it to me, is to get corporations and their leadership to step up to the plate on these issues. And the tools include shareholder proposals, proxy voting, public advocacy, and a lot of other tools that he'll tell us about. Noelle Laing is Managing Director of the Mission-Related Investing Group at Cambridge Associates, which has offices in the Washington area and here in the Boston area as well. Noelle works with investors and institutions and foundations to identify and research MRI managers. She works with investment directors, monitors managers in clients' programs. She's right at the cutting edge of all of this. And our third panelist this evening actually was before the committee a little earlier tonight. Many of you know him, Nathan Phillips, Professor of Earth and Environment here at BU's College of Arts and Sciences. Nathan favors divestment. He's an expert on environmental change and a go-to guy for my journalism students when they need a talking head on the topic, and I appreciate you're always taking the time to meet with him. His current research is focused on ways in which plants and ecosystems regulate water loss and carbon gain. And Nathan, I'm not sure what that means, but okay. I'd like to start the conversation with what we call in the television news business a wide shot. The tight shots give you the detail, but the wide shot sets the scene. It's the establishing shot. So a question for all of you, that establishing shot question. Where is the divestment movement today compared to where it was 5, 10 years ago? How has it changed? Is it an end or a tool? Tim, why don't you start us out?
Well, I think everyone in this room is well aware that the debate about divestment is global now. It's intense. It's a very real focus on climate change, and I think has made a huge contribution to the national and the global conversation. It's growing considerably as well. We've seen the debate focus attention on the issue in all sorts of boardrooms. I'm thinking of universities, foundations, religious investors, pension funds, and so on. So there's few places I go when I talk to investors, and we work with a lot of different investors, from pension funds to universities, where this isn't on the agenda. The growth also of divestment as a tool is notable. And we all, I think, are aware that Bill McKibben framed this as a list of 200 companies that he said represented the fossil fuel industry, and urges people to sell those shares. But it's also been fine-tuned by many investors, too. I sit on the pension board of the United Methodist Church, which is fairly significant in size, $22 billion. And they recently decided not to own coal, thermal coal stocks any longer. Now that, in the big picture number that you'll see in the paper sometimes, is classed in the divestment category, and it is. It is people deciding not to own certain types of securities because of the climate change issue. But I would suggest that we should ask reporters to delve a little deeper, because out of the $3 trillion that's often announced as divested funds, I would say 85% of that is institutions, huge institutions around the world that have decided not to own coal any longer. So that's just a sub theme. I think we're going to get into this discussion, but you'll see a lot of institutions who, big pension funds, state and city pension funds, who own the whole universe. They just own the world of stocks, and they feel they can't just walk away from a whole industry, although they are certainly looking at whether parts of that industry are unwise investments. The last thing I'd say here, RD, before you go to others, is it stimulated a lot of institutions to be much more proactive, to be proactive in their own house, like how is a university or a foundation acting as a responsible entity in terms of climate change, to be active in speaking out to companies that they own, or speaking out to companies as a part of the national debate. You've all seen the stories about ExxonMobil and its lobbying on climate, that is the very, very probing stories that have critiqued them. You see a lot of institutions raising those issues, both in public and with companies they either own or could own as investors. So the investor voice is writ large on the climate change debate. I'll just give you a couple of other very quick figures here. The Carbon Disclosure Project, now CDP, is global investors who are supporting the call for the reduction of greenhouse gas emissions, and for full disclosure, they have investors with $95 trillion of assets under management calling for that. That's a sea change from even 10 years ago. And right here in Boston, the investor organization Ceres, the Coalition for Environmentally Responsible Economies, has an investor network on climate risk with investors with $14 trillion. And these are investors who aren't just part of a group and sometimes speak out. They're actively involved in the whole advocacy effort on climate.
Noelle Laing, let's move to you. How has the divestment landscape changed? Where is it going?
Well, Cambridge is an investment consulting firm, and it was when Bill McKibben's article came out in Rolling Stone. It must have been 2012. I used to remember. It's been so long now. That clients first started asking us about this, and we work with endowments, foundations, high net worth investors, families, and pension funds. And so that was 2012, and questions started to percolate. Managers started to say, "Oh, by the way, remember I'm fossil fuel free," and put their hands up. And so the discussions started, and these discussions take a long time. So the discussions are ongoing. Even with some of the clients we first started talking to a few years ago, they have taken very proactive and positive steps towards having this discussion with internally and with their stakeholders, but a lot of them are ongoing. So I'd say that the way it's changed is that it's ramped up in intensity, in the number of types of investors that are asking, but also in the depth of the questions that they're asking. They're being very true to their fiduciary duty, their responsibilities to the pool of assets that they're managing, and asking very sophisticated questions because these are very sophisticated investors. And where is it going? I think it's continuing. I think, even today I'm getting questions from clients where it's the first time they're asking about it. And so I think that this isn't dying down. I think with the Paris talks and with, major weather events that are happening globally, that this is just going to continue. The discussion of climate change and should we divest from fossil fuels will be, on the front of everyone's minds continually. But I think that the nice thing is that and one of the many nice things is that this has brought an awareness of environmental, social, and governance factors into investors that maybe hadn't thought about those factors before. And what I'm talking about there are what are sometimes referred to as extra financial factors. If you look at a stock of a company, often you look at the operating performance of the company and different fundamental factors, but now people are integrating environmental, social, and governance factors into their analysis. And those ESG factors are things like the company's water usage, or how they get their energy, or their greenhouse gas emissions, and how, how many independent board members they have, and how they treat their employees, and what their supply chain looks like. So all these things are relevant to these companies. And the cool thing, one of the cool things about fossil fuel divestment is that it's put these extra financial factors on the radar of investors that maybe weren't looking at them before. And I think that that's also going to continue into the future.
Good. Nathan, where are we?
Well, it is the fastest growing divestment movement in history. And I think what's happened in the last year and a half is it's become mainstream. My wife is a very conservative person. She tells me it's mainstream. This is something that everyone really sees, I think, as a serious, not a fringe issue. When you have the Bank of London, Barclays, Goldman Sachs, Morgan Stanley, basically publishing works on the risk of investment in fossil fuels, it's an indication that this really has gone to the mainstream. And I want to thank the Board of Trustees and President Brown for convening such a constructive panel here tonight, because divestment and investment go hand in hand. Let's invest in our future and not invest in risk. And I think that's what this panel represents, is thinking of the entirety of investment, divestment, and what we need to do going forward.
We'll get to that. Thank you all for that framing discussion. When you look at the numbers, and the numbers are sort of all over the place, about 500 organizations have pledged to divest fossil fuels to the tune of, Tim, you said $3 trillion. I've seen $3.5 trillion. InsideClimateNews.org reports about 36 colleges and universities have signed divestment pledges. Stanford divesting coal, BU examining this issue, but Harvard, MIT, Williams, Yale, Brown, Cornell have all said no. What's at work here that these institutions and institutions of this size and stature and weight are saying no to divestment? What's going on? What's the commonality? Jump in.
Well, I think they all put out their statements, so I think you can read why they're not divesting. But I think the important part to remember is one that I touched on, that all of these institutions are thinking about their fiduciary duty. And when I say that, what I'm really saying is that they have to treat the students and the faculty, the benefit from the endowment today, equally to the future students and faculty. And so they're taking this request for divestment all very seriously, and many of them will say that they're doing other things. So they're improving the green standards of their buildings on campus, or they're going to invest partially in positive green type investments. So I think that as they've explored this fossil fuel divestment issue, many of them have decided to put out these statements that, no, we're not going to do it, but many of them come with this additional step of, but this is what we are doing. And you can't speak for, the why they're not divesting, again, that's kind of in everyone's individual statement. But I think that they're seeing other opportunities elsewhere and maybe a better way to take care of that risk that's being presented to them. That would just be my...
I can add a few thoughts to that. I sit at a table at series meetings with a number of pension funds, mostly not universities so much, RD, but pension funds and religious organizations, trade unions, foundations, and so on. And I guess the first thing I want to say is building on what Noelle has said. Whatever position these investors take, the level of concern and intense concern, knowledge and desire to act on climate has risen considerably. If you are CalPERS, the California Public Employees Retirement System, you can read on their website what their position is on this. They've chosen not to divest, but not because they disagree with the claims that Bill McKibben and others are making that the climate is going to hell in a handbasket, that there's great risk out there, that we must address this with tremendous urgency. And they have chosen instead to use their voice and their leverage and their power as a fairly significantly sized investor with companies that they own shares in. So they'll talk about filing shareholder resolutions, talking to companies, making public statements. But there's also pressure in the legislatures to take some kind of divestment action. And they are listening to that, and I believe the state of California pension funds will probably move in the direction of coal divestment in the near future. And you're seeing that pressure in New York City and New York State. So they prefer not to sell stock as a statement, but to use their shares in power to try to influence companies. But on occasion, they will actually step away from certain companies. So these very same pension funds, and I think many universities, decided not to own stock in companies that were in the Sudan because of human rights violations, or many of them sold stock in certain companies that were in South Africa in the apartheid era. So you may find some of these huge institutional investors who have a position, but will also participate in selling certain kind of stock. I'm going to go back with one final point to Noelle's point about these extra financial issues. So there's a coalition of investors called the Principles for Responsible Investing. Harvard joined that, by the way, partly as a response to the divestment pressure. And the PRI is global investors, $58 trillion of assets under management. And these investors state as a matter of belief that environmental, social, and governance issues must be taken into account in the investment decision because these issues affect the bottom line. They're not starting from a social or an environmental position per se. They're starting from thinking as investors about risk and impact on their portfolios for their pensioners. But they come to the same place. They come to be very concerned about climate risk. Some of them may, because of those ESG factors, step back and not own certain companies' stocks any longer, screen them out. And others of them will still say, my choice is to use my power as an investor to put pressure on. So this growth of by mainstream investors, it's not groups like my own firm, which is a small firm. We manage $8 billion. It's not insignificant. But we're not Wellington or State Street, right? But you're seeing some of these mainstream firms paying great attention to this. And it goes back to your very first question, because the debate is very real and many, many clients want it. I think that you'd say that too, Noelle, that as a major consultant in this country, you're responding to your clients.
Oh, yeah.
They care about it.
Yeah. Nathan, what do you make of the fact
Well-
that big influential organizations like Harvard and MIT and Brown have said no to this?
Well, I think that the idea of fiduciary duty, yes, investment managers do have a fiduciary duty, but I don't know that that's the biggest issue that's preventing some of those schools from divesting. So on that, the California pension funds with the teachers and the public employees lost $5 billion on fossil fuel investments in fiscal year 2014. So, and even the American Petroleum Institute, their own reports say that fossil fuels are more volatile than other stocks. So the idea that investing in fossil fuels somehow stabilizes and provides reliability is not something that I think it really holds up. But I think if you look at MIT, Harvard, Stanford, and some of the other schools, the influence of the fossil fuel money directly is huge. And I credit Stanford for divesting from coal in spite of the fact that ExxonMobil invested $50 million in an energy institute. The Koch brothers are heavily invested in MIT. Coal is invested very, very heavily in Harvard. And so universities are facing that issue as well, that it's not necessarily the endowment, it's funding for research that's being bought by the fossil fuel industry. And I'll just add that after the story about Exxon broke in Inside Climate News in the LA Times, one of the first responses from Exxon was to talk about MIT and Stanford as their partners in doing the research on climate change for many, many years. So that, as well as the Columbia Journalism School, when the story broke, Exxon wrote a letter to the dean of the Columbia Journalism School threatening withholding of funds to them. So I believe that the fossil fuel industry is influencing universities through their funding of research.
Okay, we'll
I just
come.
add go ahead.
Noelle, go ahead.
I was just going to say, I don't think it's necessarily that the schools feel, and again, I'm just kind of speaking generally, that they have to be in fossil fuels to get a certain type of return or whatnot. But I think it's often couched as we don't want to limit our opportunity set. And so if you're taking out something that just eliminates something that we have the potential to invest in, and if you look at prices where they are today, if you're a value investor, you're saying, well, these stocks of fossil fuel companies might be undervalued, and should they increase in value, we might miss out on that big jump. So it's not to say it's right or wrong, but I think that's what people are looking at, is they're saying, is this providing me a good investment opportunity today, and do I want to eliminate that completely from my portfolio? What might happen to my returns in the future? And no one will know, but I think that's what they're really exploring. And I would also just add on the difficulty, something I failed to mention, is that you have to understand how large, sophisticated endowments are invested. They're invested across all sorts of different types of asset classes. So not just stocks and bonds, but hedge funds, venture capital, real assets. So many different types of investment opportunities are available to these large institutional players. So, but they're also invested in commingled funds. So these are vehicles, investment vehicles, where your money is pooled with other people's money. So for you to say, I want to get out of fossil fuels is almost impossible in this commingled fund structure if you're in, pooled with other types of investors, because then the investment manager would have to just wipe out fossil fuels from that entire fund, and that may or may not be, they may or may not be willing to do that. So I think that that's another complication that you have to think about, and often you'll see in these statements from schools, like I think Stanford said, we're going to divest from our direct holdings in coal, and that's because Stanford is saying we probably have commingled funds, or other schools are saying we have investments in commingled funds, but we might directly hold some stocks as well, and so the ones that we have control over, essentially in that way, we'll divest from those.
I just wanted to add quickly, I think Nathan's hit a very important point about how money talks, and it talks in Congress too. So if we look at the monies from the Chamber of Commerce or the lobbying the Chamber of Commerce does, they've spent $1 billion lobbying since 1998, and the Chamber of Commerce is a vigorous opponent of the Clean Power Plan of the administration, sued the EPA as a result, unfortunately, putting a stay on the Clean Power Plan now. So that money that Nathan talks about is very important. I would say, though, Nathan, that grabbing a quick snippet and saying somebody lost a lot of money because they owned a certain sector in a given year, I think you probably got to look over 10 years or 20 years. If you're a long-term investor, that doesn't convince you. I mean, it's not like, gee, I lost a lot of money because I happen to own Exxon. Even though you did lose money last year, you are right. But looking longer term, and here's where the common sense approach that Noelle talked about too comes into play. Longer term, you're having many more investors saying, I don't think coal is a good buy anytime in the future. I think it's time to leave it. And some people are talking about oil sands that way. And then just to take the step, I don't think the pension funds or the universities have taken this, but the case is being made that long-term fossil fuel companies are going to be sitting on a lot of stranded assets. You've heard the argument, because those assets can't be burned. We will have fried our planet by the time we burn all those reserves. And therefore, they are not as great a long-term buy as one would think. That is getting a lot of very serious look from mainstream investment managers and consultants and others. It's not being dismissed. It's not just a trite argument at all. And believe me, it's being paid attention to in the boardrooms of major oil companies, some of whom are debating should they diversify themselves and not just be an oil company, but have other renewable energy sources, especially European fossil fuel companies thinking that way.
I want to turn a corner. Nathan, you used a term a moment ago, and Noelle, you used a term a moment ago that provides the pivot point for a turn here. Nathan, you talked about fiduciary responsibility. Noelle, you talked about the unique nature of endowment funds. What you're suggesting here is that endowment dollars are somehow different in the investment world than my dollars in my 401k. How are they different? Or are they? In terms of fiduciary responsibility, in terms of donor-specified uses for the money? Mm-hmm. There's a whole list of things here that potentially limit what you can do, aren't there?
Yeah, absolutely. So for an endowment, which is basically a pool of donated money, you have to make sure those who manage that money have to make sure that that capital will be available for future generations, as I referenced. And so you have to think about it in perpetuity. So that's why it's so important. That's why all these discussions are so involved, is because any decision that a fiduciary of that money makes, they have to make sure they're not going to harm future the capital that might be available to future generations. And so that is different from you. You know, if I had $500 million or $1 billion, you know, I could invest it however I wanted, and it would just impact myself and maybe my family and whatnot. But these endowment dollars have to be, you know, used for specific purposes for the organizations that they're housed for, and they have to think about that statement of managing them to perpetuity.
It's a legal responsibility.
It's a legal
too.
responsibility. Thank you. Yeah.
Nathan?
Yeah, I think the mechanisms and the details really matter on investment and divestment, but I do want to make sure that we don't conflate the nuts and bolts, how you do it, with the principles that are involved in what is right to do. And, you know, I think that if we say it's just very hard to do and we don't have the mechanisms to do that, universities, that's what we're here for. We innovate. Our business school can help to develop the kinds of investment portfolios that can work. I've had discussions with Professor Janados here in the audience, Ian Soo Wing, an economist in our department, who have thought of very innovative ways in which investment mechanisms can be done. So I think that BU, it's a great opportunity for some of our best minds to help to move that forward. We were talking just before this panel about the fact that there is innovation in the investment world. Both of you are actually at the forefront of that, but the NRDC, working with BlackRock Investments, has put forward a mixed fund, as I understand. You know, is it something that works for everyone? No, but we're moving in that direction, and I think that's a very positive sign.
In 2013, Harvard's Drew Faust spoke to this issue you raise, saying, quote, "The endowment is a resource, not an instrument to implement social or political change." And BU's President Brown has said about the use of the university as a tool for social advocacy, quote, correct me if I'm wrong, sir, "Not never, but it's a very high bar." Comment?
Well, it is a high bar, and it should be. But I think we all agree universities have a mission. They have a core values that matter. They express those values every day, not just in the classrooms, but through the administration. When it relates to their investment portfolio, as Nathan said, it gets practical and complicated. But I don't think that means that you walk away from your mission and your values when you're looking at the complicated part of the story. So the interesting thing is the very schools, Drew Faust, in her statement, seemed to pass by the fact that Harvard had made a very strong statement and divested from the Sudan. And 2 decades ago, Harvard University Medical School said, "We are investing in tobacco. We know that tobacco kills people. Our mission is to create health at the medical school. We should not own those stock." Harvard doesn't own tobacco stock. So again, this doesn't make the decisions easy. And I'm with you, Nathan, that we need to look at the moral imperatives too. But I also would appeal to those of you who are strong believers in divestment to at least acknowledge that there are some people who feel that passion, but are going to choose a different strategy to address that moral imperative. But again, back to summarizing the point, I think universities need to walk that tightrope. They have to look at fiduciary duty, they have to look at their mission, they have to look at their moral responsibilities, and it is not easy. But it doesn't, as the committee well knows, it doesn't mean they walk away from the issue. They're trying to figure out what is best to do. So I think that's, I'll just add that this is the same, the language may be a little different for a foundation or a religious group or a pension fund, but they face many of the same questions, maybe framed a little differently than you brought up, Argy.
When you look at the timeline on this issue, BU divested South Africa and Sudan. What's different about them and fossil fuels? Why was the university able to divest those two? And is it harder to do fossil fuels than it was to do South Africa and Sudan?
Well, one simplistic answer is the Sudan list was a very short list. There were a lot of Chinese oil companies and so on. It wasn't like you had to divest from 200 or 250 or not invest in 200, 250 U.S. companies. So that's a little different. The South Africa issue, though, this goes back decades. We were involved in that work when I worked with the Interfaith Center on Corporate Responsibility from the 70s on. And there were 300 U.S. companies in South Africa. So that was a hard piece of work when the University of Wisconsin decided not to invest in any companies in South Africa, or some universities and religious groups decided to divest of certain companies whose behavior in South Africa was unacceptable. They made those kind of choices.
Nathan.
Well, I'd like to respectfully take issue with the framing that the investment is not a political instrument as it is. So Boston University is invested in coal through its mixed funds. And, whether we consider that to be significant in dollar terms or not, I think of it as it's a vote to keep coal going, for example. And, investment means a support of further extraction of fossil fuels. So there is a political component to it. And as well, there's a term that some have used, carbon humanitarianism, that we need to stay invested in fossil fuels because some of our most vulnerable populations around the world need it. And so that clearly is a statement of an endowment as a tool for social good. So it can't be argued one way and then the other. But I contend that it has a political dimension to it as it is.
Noelle.
I would just add to the point of maybe voting for coal, just that what I hear from investment managers that I meet with all day, every day, because I meet the ones that are thinking about positive movement forward and positive investments, is that there's no perfect company. So I would just keep that in mind as well. I'm not saying yes or no to coal. I think it's very we all know it's very dirty burning fuel and all that, but I think that you have to keep that in mind as you think about investments. I think you can take issue with almost any company out there, and as you make these arguments, you have to think about that.
A couple of terms have come up in the conversation: commingled funds or money and direct investments. Draw the differences here, and what is the significance of that when it comes to discussion of divestment or targeted investing?
So if I'm investing my 401k and I can use a broker platform and maybe buy individual stocks, that would be a direct investment. I'm making a direct investment in an individual stock. But if I'm using mutual funds in my 401k, that's a commingled vehicle where I'm investing alongside thousands, if not more, of other investors. And so I have no control over what that fund holds. I'm just picking it because I believe that the investment manager managing that fund will make me money over time, and maybe I get an ESG fund at the same time. So that's the difference. You have control over direct holdings. You don't have full control over the commingled funds. And as I said, many of these institutional investors, most of their portfolios is made up of commingled funds. And you have to even think sometimes a separately managed account where you might have more control because you're the investor's the owner of that separately managed account with the investment manager. Those aren't always practical in different asset classes. Again, speaking to the complexity of an endowment portfolio. So in emerging markets, for example, if you're invested in emerging markets equities, which most, if not all, major endowments and foundations are invested in, you're probably in a commingled fund because it's very challenging to do that through a separately managed account. You basically have to have direct access to all the individual emerging markets, and it can be very hard to get that. So you do that through a commingled fund. So if you just think about trying to divest a total portfolio, there are certain asset classes within that portfolio where it's almost impossible to get that direct exposure.
Maybe I can add a point, because I like Noelle's comment about the individual who chose a mutual fund. But that doesn't mean we're totally powerless if we own that mutual fund. But it's different than owning the individual stocks and being able to vote our proxies or write the company or decide not to own a certain stock. But I can either choose a mutual fund that takes these issues seriously and maybe is a champion of the issue of climate change, or I can ask that mutual fund to do some things because I am an owner, partially, of the shares in that fund. I could ask them to take climate risk into account. I could ask them to tell us, are they going to own coal stocks? And if their clients ask them these questions, they start looking at it twice or three times. And many of these mutual funds now are under more scrutiny about how they vote their proxies. So likewise, already in a commingled fund, the common fund, which manages a lot of university money, is paying a great deal of attention to these issues. They are in tune with the discussion we're having tonight. And other funds, like Vanguard, are under a considerable amount of pressure about how they vote their proxies. They don't vote for any social or environmental issues. They just keep those on the side. And there are many people saying, you're actually misusing the power of the proxy. And back to the fiduciary argument, you aren't being a prudent fiduciary because you're not taking into account that companies are doing things that are affecting the bottom line and you're supporting them. Isn't that an interesting turn? So an institution who is part of a commingled fund is not like that. Reality makes them either powerless or outside of the realm of having a discussion with them.
Nathan, what's your approach to this commingled direct investment issue?
Well, I'd like to talk about the direct investments because I've heard, and I don't know this for a fact, but that BU and many other colleges may not have a lot of their investments in direct investments in fossil fuels. So what's the actual value of divesting from something that you don't really have a lot in? I think Stanford's been criticized for that as well. I actually think it's hugely important and hugely meaningful to divest in such cases for the very reasons that Noelle mentioned, that what if the price point is just great to open up a big investment in oil, gas, or coal because the market conditions seem right? Is that something that, we ought to be doing? And if we make a statement of divesting from at least make a statement of divesting from direct stocks, we're basically not just talking about what we have now and in the past, we're talking about our mission going forward, that we're not going to invest in the further exploration of the fossil fuels that we have to keep in the ground. We know we have to keep 80% of the known reserves on the planet in the ground. And if we start investing because the price signals look good to us going forward, we're really, that's where the moral argument comes in. It's just not right to do.
So institutions, organizations, foundations, universities, colleges that sign targeted investment agreements that speak specifically of direct investments, are they getting a freebie here that in many cases it's not a lot of money?
I don't think we can make that statement. I think you have to know what they're holding. So, you know, it's hard to say whether they're getting a freebie. I think it's, you know, they've made this statement. To your point, it's still a powerful statement, and you have to really look under the hood and know what's in there to know, you know, how powerful that is.
The other thing that's notable, and we referred to it obliquely a couple of times, is the growing number of opportunities to invest in perhaps commingled vehicles, but that are part of investing in renewable energy or in this transition away from fossil fuels into a new energy future. So Ceres has actually started a campaign to support a clean $1 trillion a year campaign, that you're investing in a positive way in terms of climate change. That's a little different than talking about divestment. It's talking about putting your money to work to making a difference. There's risk here too. One would wish that solar was a great investment right now. It's still a tough climb, but looking forward, it's likely to be that solar and wind and biomass will be investment opportunities because they'll be much more in demand. They may be in demand in part because governments start requiring it as part of what we expect, or because there's going to be a price on carbon, and therefore solar would be much more competitive with than oil and gas, with oil and gas. So that should be part of the discussion. It's not just BU, it's what any institution's doing as they're looking at their opportunities to make a difference on climate change. Looking at positive investments in renewables is an exciting possibility.
Speaking of government, I want to come back to a point you mentioned earlier, and that was the California pension system, which I believe the California Assembly has voted to divest coal. But the last I checked, Governor Brown was still looking at that bill.
Yeah,
not sure.
It's not law yet, but
it's not law yet.
Both pension funds are looking at it very carefully, not simply because the legislature is asking them to do it. They're looking at it from a wise investment point of view, too. So they may well, in the end, if they do it, they may well say, we're doing it because we're being a smart investor, and it also is a decision that has a positive impact on the environment and climate. But it's not law yet.
What I'm hearing in a larger sense from all three of you is that good business practices and investing your values are not necessarily at odds, but it's not always easy to make the two mesh. So let's talk about risk for a second. Nathan, I know you're very concerned about risk, not just short term, but longer term. Tell us about your
So
stand
my
on that.
overarching view and philosophy is, let's not invest in risk. Let's not gamble our future. And that's on three different levels. One is our BU endowment. As I mentioned, the American Petroleum Institute's own reports talk about the volatility of fossil fuels. It's more highly volatile. And so even notwithstanding the losses that have occurred in the last couple of years, we expect them to be more volatile. So we should be minimizing our investment in risk there. And as well, since the Paris Agreement and we are looking at a structural change in our energy system. So the volatility that we've had has been high, but looking forward, we're looking at a very different energy landscape as wind and solar take off. And so that there's the let's not risk investment risk in our own endowment. And then there's the risk of our most vulnerable communities. Let's not invest in that risk through our endowment. And I spent a year in the California State Legislature, and at the time, a major landmark climate bill, SB 350, was being put forward that would reduce petroleum use in the state of California by 50% by 2030. The Western States Petroleum Association spent $22 million to kill that bill. And the legislators from the San Joaquin Valley, which has the worst air quality in the nation due to the burning of fossil fuels, fought tooth and nail against that legislation. So let's not invest in that kind of capture of our legislative bodies. And then finally, let's not invest in the risk for our children, for the students in this room who are going to bear much more of the brunt of climate change than some of us older ones are, and for our own children, and for some of us, even our grandchildren. Let's not invest in the risk that we're putting them at.
A very thoughtful piece by a BU medical student this week in BU Today, a point of view piece, talking about investment in fossil fuels as a public health issue. Are you hearing that from your clients?
Well, I think we're seeing that in a lot of the policies and regulations that are coming about, and we've been talking, when we talk to investment managers with our environmental hat on, in my group, we often say, okay, we're worried about regulations changing. Tim mentioned the clean power, the stay on the clean power plan, et cetera. How can we think about the risk of regulations changing and maybe an investment that we thought was positive from an environmental perspective and a financial perspective, maybe it's going to turn south. And what we often hear is these policies and regulations are actually being put in place because of public health reasons. So you can't expect them to be, repealed because of that reason. So they have real staying power. And I think you have to probably look at them, one by one to really do the risk assessment justice. But I think that that's a really important point, and that hopefully we'll see more positive environmental legislation because of that.
Tim?
I'm so glad Nathan brought up the point of lobbying in California on the SB 350 it was, right? So the issue of how fossil fuel companies are lobbying in this country on everything from the Clean Power Plan to California's legislation for companies that were out there, to some of you may be aware of the group, the American Legislative Exchange Council, ALEC, which is actively involved in trying to oppose renewable energy regulations at the state level. So who supports ALEC? Well, Pfizer and Exxon and Chevron and so on. And Nathan, just so you know too, here are the investors that I mentioned earlier that have a great deal of passion about the climate issue and aren't walking away from their responsibilities, have challenged every one of those companies on both their lobbying in California, but their support of ALEC and what they do through the Chamber of Commerce to fight against the Clean Power Plan. So there will be votes at the stockholders meetings of Chevron and Exxon, for example, resolutions led by a number of investors who are pushing them on lobbying disclosure and raising these very issues as they do. So I'm simply acknowledging that this spring, as people vote their shares, they'll get a chance to vote on how companies, not just oil companies, but how they're lobbying on climate.
I just forgot to mention as well, there's an environmental justice, a very strong environmental justice and climate justice piece to this, because in that particular example I mentioned in the San Joaquin Valley, heavily Hispanic, low-income neighborhoods, they're bearing the brunt of the fossil fuel infrastructure that the fossil fuel industry is, basically funding, to suppress the legislation that would help our most vulnerable populations, both in the United States and around the world.
I want to spend a few minutes on options beyond divestment. What's happening in the marketplace, and to what extent is the market absorbing the arguments for divestment and incorporating them into products? Noelle?
Well, this is really exciting. I think it's the most fun part of this topic personally, because it's what I do every day. But we've seen a real growth in investment opportunities. Now it's starting from a pretty low base a few years ago and growing every year, so that's great. The interesting thing, to Tim's point about solar maybe being a tough investment today, it's actually have to think, if you think about an endowment's very sophisticated portfolio, there are many places where you could actually play solar in an endowment. So maybe the public solar stocks are not looking very attractive today, but the fact that the prices of solar panels per kilowatt, the solar per kilowatt price has come down, is actually great for solar developers, solar field developers. So that's been a boon to a private infrastructure play that you could have in your investment portfolio. So I think that that's the interesting part about being such, representing such large investors, is that, an opportunity in the public market space in one area of clean and green investing may not look good, but you could have other options in the portfolio, specifically in, maybe a privately held vehicle.
Tim?
So other options that investors are using, and some of them may be investors, by the way, do some divesting or selective divesting, but certainly speaking out on public policy issues is increasingly seen to be important, and there's no reason at all universities can't take their deep concern about climate and their moral voice and join with other investors, however their funds are structured, to speak out on the need for, say, a price on carbon in our country. So we saw before Paris all sorts of major global companies speaking out on the importance of climate change, addressing it, and looking for solutions. And a number of them actually spoke out, and these were major companies, saying there was a need for a price on carbon. So I think we will see Ceres and other groups provide opportunities for investors to speak out and be part of this. Lobbying in Congress, letting your members of Congress know that climate is an important issue, that you expect them to be leaders on it, I think is quite important. It's springtime. Voting your proxies is an important part for all sorts of investors if they, whether they've selectively divested or are not divesting, they need to cast their ballots. And some, as I said, you're talking about options. Some investors are looking at selective screening, where they're actually building into their criteria for what decisions they make or their managers make for buying stock, looking at climate risk and other climate change issues too. So there are multiple. I'm sorry, and then of course the other positive side that we talked about, investing in solutions, is another option.
Nathan, is there anything short of divestment that fulfills what you want to see happen?
Well, I think that the BU Sustainability Initiative has been amazing. We've done such great work here under President Brown's leadership and Dennis Carlberg and the students like Lindsay Chu that have been doing such great work on campus. And so it's consistent. I look at divestment as not the end point, it's the starting point. Even though we've started in so many different ways, and it's something that we should, I think about advocates and activists who talked about the Paris Accord, the road not to Paris, but the road through Paris. And I think that what we're on a pathway here is it's the road through divestment. I hope BU makes the right choice. Whatever choice they make, we're going to continue to go forward and address climate change because we have to. And we've got such great momentum with the BU Sustainability Initiative. I also think we need to think of investment in a wider sense, including investing in on-campus efficiency, renewable energy, and those kinds of things. So,
which was the approach that Williams College took when it said no to divestment and instead said, let's invest here. And they pledged something on the order of $50 million over the next 5 years, I think it is, in exactly the kind of thing you're talking about. Thank you for our conversation. Now let's get you into the conversation here. Where to start? An important part of divestment is reinvestment. What specific organizations' products would you advise investing in rather than fossil fuels?
Well, there are lots of options these days. That's the nice thing about it, is that, as we talked about, there are environmental, social, and governance investment managers who are taking those extra financial factors into account. And they're often doing that with a best-in-class lens. So they'll look at companies from both that fundamental financial perspective and then the ESG perspective, and they'll invest in companies that are both attractive from that ESG perspective and that financial perspective. So there's that type of investing that's mostly in the public market space. And then, as we were talking about before the session, the green bond market is growing very rapidly.
What's a green bond?
A green bond, so as you probably know, a bond is essentially a loan. So if you invest in a bond, you're lending money to the issuer. And when you invest in a green bond, you're lending money where the money is being set aside solely for climate adaptation or mitigation type projects, so green and environmental projects. And we've seen it started with big issuers like the World Bank building this market, but now we've seen it move into the municipal bond market, the corporate bond market, and others. And last year, I think this market was 42 billion. So a very small market for the total, trillions of dollars in the bond market, but a growing area of green and sustainable investing. So that's in the fixed income market. And then, as I mentioned, on the private investment side, in areas like venture capital and private real assets, there are some very interesting plays. Clean tech didn't go so well. Clean tech venture capital didn't go so well for most investors in kind of the mid-2000s. But now we're in this clean tech 2.0 era where we're focusing a lot on energy efficiency and resource optimization. So your options in this area are things where you may not be building solar panels, but you're having a very positive impact on the climate in less capital intensive ways. So for example, I know of an investment in a technology that helps turn solar panels throughout the day so that they're capturing the most sunlight that they can throughout the day and providing more energy that way. So that was a big, that's the type of thing I'm talking about, or an investment in, like a Nest thermostat, anything where you're kind of measuring and managing the energy that you're using is pretty popular, smart grid investments, et cetera. So there's a lot of innovation, there are a lot of options, and we're seeing some investment managers really start to pay a lot of attention to that space.
But the key here is you probably have to be thinking longer term, not short term with these.
Yeah, these private funds, which are in a lot of endowment portfolios, you lock up your capital for 10 or more years. So yeah, these are very long-term investments.
Interesting example. Yesterday, Apple came out with a green bond. I think the University of Texas came out with one this week, and the state of Massachusetts has had several. So at least we have a number of clients who've chosen the divestment option, but they don't want it. As Nathan said, you don't stop there. They said, well, we want to make sure we're investing in positive ways, and therefore they've been pushing to find such opportunities, and including green bonds and companies that are on the cutting edge.
With regard to fiduciary duties, don't the moral responsibilities of providing for future generations outweigh the fiduciary responsibility?
It does outweigh it morally. It does outweigh it socially. It does outweigh it in terms of a long-term view of what's got to happen globally. But if you are a pension fund or an endowment trustee, you are legally bound. It's not your money. In the Methodist Pension Board, this is other people's money, so to speak. You're a custodian, a steward of that money. You have to act in a way that's responsible for their long-term interests. That's a moral obligation. If you don't do it, you can be sued. So I want to just stress, because I think sometimes the fiduciary duty argument's brought up and people dismiss it as, well, that's just an excuse to stay away from divesting. You can be a prudent fiduciary and still screen your portfolio. In fact, the Department of Labor has recently said in a ruling that indeed you can take these issues into account. And lengthy legal briefs have been written recently saying that indeed it is the responsible and prudent thing to look at the social and environmental issues as you weigh your fiduciary duty. But it's like you're weighing them on a balance. You can't just say only one matters. Now, let me hasten to say, as Noelle said, if she bought her own shares, she's free to do what she wants. The Sisters of Charity might say, our investment portfolio doesn't have any restrictions. I'm free not to invest in anything I want or to take higher risks in some positive investments because I believe in it deeply. And that happens in some parts of the investment arena. But if you are an endowment or a pension fund, you have to be very careful. Your legal counsel will remind you of your legal responsibilities. I want to say that in the past, those legal counsels basically said you couldn't do it. I think now wiser legal counsel is saying you can do it, but you have to do it very thoughtfully, carefully, and taking all these factors into account. But it's
Nathan,
not
same
a
issue.
no-go.
Yeah, I want to pick up on something Tim said, which is long-term responsibility. So if it's all about short-term gain, I think that people can be really smart, but be part of a very unwise situation. Like with the housing crisis, it was all about musical chairs and whether you could get off first so that the next person held the debt. Should we be participating in that kind of short-term gain? So I think the time scale of responsibility certainly is very germane to this. And again, the volatility and the risk is something that you can win big on short time scales, you can lose big on short time scales, and I think that we need to take the longer view.
And I would just say that when I bring up fiduciary duty, it's, to Tim's point, it's not to say that you can hide behind it and say we can't divest our fiduciary, because of our fiduciary duty. It's really to explain why it may seem like these conversations are taking a long time, why it's prudent for these conversations to take a long time, and why you really need to fully assess all your options. So I just want to...
Several of you have talked tonight about the importance of being an active owner, voting your shares at the annual meeting. One of our audience members asks, do you know of any cases in which shareholder activism has caused a corporation to change its fundamental business model, as the fossil fuel industry must do in order to keep 80% of known reserves in the ground to maintain a stable planetary climate?
I want to meet who wrote that. That's an exceptionally important question. It's a very probing question. It's one of the strongest arguments against engagement with fossil fuel companies. So well said. Let me then say two things. One, there's hundreds and hundreds of examples of companies changing because investors have leaned on them on everything from their executives' compensation to putting women on the board to setting greenhouse gas reduction goals. And that includes oil and gas companies who've been pressed to set greenhouse gas goals, use renewables, have a impact on how they do business. But the probing question there is, does it change their business model? And I think anybody who is an advocate, a shareholder advocate, would be spinning it if they said, oh yeah, there's a lot of examples of that, or we're quite confident it will happen. That said, I just want to pose, at least put a hypothetical on the table or a question on the table. The selling of stock makes a strong moral case, a strong and urgent statement. I'm not sure that it gets paid that much attention to in the boardrooms of Exxon unless there's hugely significant institutions doing it. Then it does matter. It's a very embarrassing for a company when, say, Harvard sold its stock years ago in certain companies that were doing business in South Africa. It's an uphill climb to change the boardroom thinking in Exxon by selling your stock. And I would confess that it's an uphill climb to be knocking on their door, having meetings, voting at their stockholders meeting, calling them out on their lobbying. But I'm glad there's some investors who are still doing that. I happen to think, in a strange way, that the pressures on the fossil fuel industry to rethink its model is being built in part by strong institutions who are divesting, and in part by investors, huge investors, who are saying to them, you've got to rethink who you are. It's a different world you're going to live in. And I think those pressures are actually, there's a synergy rather than an opposition one to the other.
Any other thoughts on that?
Are there early questions from the laptop, or can people raise their hand?
I'm sorry?
Are there early questions from your laptop, or can people raise their hand?
Well, we were trying to do it with this. If I'm happy to entertain a question if you have one.
Oh, yes, thank you. I appreciate it. Thank you. My question really is connected to, well, we were just talking about a moral issue. When we look at big issues over time, when we think of, again, the apartheid movement that I was involved in many years ago, and well, even bigger issues. The big changes in America have been, bottom line, things were very lucrative, you made money, but they changed because of moral imperatives. We can think of slavery, we can think of belated recognition, indigenous people being pretty much wiped out in the United States, and we realize it too late. One thing that hasn't been addressed here, and we're not really looking at too much, although we touched upon it when Nathan spoke about children, and that's really the investment, isn't it, is the time factor. All the things that we're talking about, and it's very informative what you're saying, but there isn't really a lot of time. We don't have really 40, 50 years. The IPCC and others point out about Miami and Calcutta and other issues that we can't really change that. We can minimize those problems, but only by very immediate action, not by something that evolves over 10 years. So I apologize for this little speech, but I do think that Boston University is in a precious position to take leadership on this in terms of a moral point. It will get recognition around the world, and it will lead other institutions of great repute like here. And so that's my 2 cents in here.
All right, great. Thank you very much. Any comment on that, the urgency? There is an urgency attached to this.
Yes, I think it's the urgency is underlined by everyone who's working on this, from the scientific community and the IPCC. Interestingly enough, it's being underlined now, and it's different from 2-3 years ago, by hundreds of companies who actually recognize the crisis that you're talking about. You might know the report Risky Business that came out a year or so ago, headed by Hank Paulson and George Schultz, people from one side of the political spectrum, and Tom Steyer and other liberal advocates. And they're talking about the risk to our society, our business, our economy, our stock markets, trying to, rattle the cages of that boardroom too. So I guess my comment back about institutions taking the urgency seriously, acting with a kind of an urgent voice, I'm with you. I'm just suggesting there may be 10 things a university or foundation or religious group could do as investor that sends that urgent message. It's not simply one. It's not simply I'm selling my stock and I'm walking away from this company. It could be that, but it also could be other things.
Nathan?
I think that the people who are feeling the sense of urgency maybe more than anyone are our younger people, our college students. They overwhelmingly support very rapid change on this. We had a 75% referendum from the undergraduate students in favor of divestment. When I teach them every single graph about the global climate, everything's going off scale. Everything's going off scale. And this generation of students, they also know about things that go off scale, like how fast technology can move. So, the scaling of technologies. We're talking here as professionals. We've been in the fields we've been in for decades or several years. I just want to put out there, the big changes have come from the younger people. If you think about the business models that have really scaled, think about Google, think about Airbnb. These are things that changed the world. They are changing the world, and the leadership is coming from younger people. And I feel confident that at Boston University that leadership is going to continue from our youngest, because they know about rapid change, and they know about the urgency of the situation we're in.
Several variations on a question. What's the bottom line? What percentage of BU's portfolio is actually tied to fossil fuels? How can the BU community learn more about where BU's investments are made? And I don't know the answer to that. That's proprietary as far as I know.
I don't know the answer to that, but I would just say, think about, if you think about investments and activities that are tied to fossil fuels, it's a broad question, and I know what you're asking, and I don't think any of us can answer it, but just, I would almost turn that around and say, think about your own life and the demand of fossil fuels that you're putting on, because I think, or the demand for fossil fuels that we all have, you know, it's oils in our clothes and we fly and all this stuff. So I think, I just wanted to highlight that as well, that I think change can come about from, you know, the demand side as well. And so to Tim's point of kind of shareholder engagement initiatives and other ways besides just divestment that we can have an impact, it could be engaging with companies to just lower their energy demands. And you know, the positive side, the technology innovation side, you know, that's what I'm kind of up here representing, is that there are cool investments, really attractive investments on the positive, proactive side as well. So to the point of kind of where, you know, how an endowment could take a stance on this, there are many different levels of that.
It's fascinating. The last 6 months, our company's talked to 50 companies about their greenhouse gas reduction goals, using renewables and cutting energy use, which is also saving money, of course. And so one aspect of this, which I think is yet still a vision, not a reality, is as our society and as our companies need less fossil fuel industry energy, it actually, of course, cuts demand, and those reserves that Nathan was talking about makes them less necessary to bring out of the ground. So that we bear some responsibility, as Noelle says, to say to the fossil fuel industry, who says, well, my business model is to meet customer demand, to serve my stockholders, and I'm going to keep on bringing oil to market. But they won't do it, and they won't find new oil and spend money to find new oil if the demand is lessened considerably. So it's just part of the equation we need to be aware of, I think.
Let's take a couple from the audience. Yes, sir. Here.
I don't have a phone. I'm working in Brookline trying to persuade the investment boards to divest. When I Googled fossil-free mutual funds and looked up the 10-year return graphs, I was dismayed to find that only one such graph compared favorably with the S&P 500 graph. Am I missing something?
No, I think that's an interesting point. I think it gets back to the overall investment thesis of a certain fund or investment manager. So, I don't know the exact list you're looking at, but if they're not showing outperformance, there are many, many reasons why that could come from, or why that could be. So they might be ex-fossil fuels, so that's a big factor into how they perform relative to the broad market. But there might be ex-fossil fuels, but they're investing in something, so maybe they're not that skilled at the investments that they're actually making. And again, it's a 10-year period, so it's very start and end point specific. Maybe if we took it out to 12 years, it would tell a different story, or down to 5. So yeah, so it's all these things you have to really dig in, to understand all these things. But I think that's a good point that you bring up, that just because you might go fossil fuel free and maybe energy doesn't go well in the future, maybe the stocks don't perform well, there are other factors that might influence the performance of the portfolio as well.
And 10 years ago, there were probably, I think you said there were a very small number of such funds you could look at. Now there'd be many more, so the number of funds is growing.
Yeah.
And as Noelle said, if you're looking at over the past 1, 3, and 5 years, the number will look different. But I know we've had clients foundations who are environmental foundations, who just chose, they didn't even know what the word divestment meant, but they chose not to own fossil fuel companies 15 years ago. And they've been able to outperform the market simply because we were fortunate enough and maybe wise enough to find substitutes for the fossil fuel companies that would have been in their portfolio. And they've done well. I think the numbers, you'll see a lot of studies in the last 3 years and going out 5 years who are starting to argue the case that you're going to do well by avoiding fossil fuel companies. They're making a financial argument, not an environmental argument. Nathan raised one of those points when he talked about 2014 returns in the energy industry. The last 3 years, you haven't done well owning fossil fuel companies, right? But that doesn't mean it wouldn't be true in 5 or 10 years.
And to a point that Nathan made too, many, that there weren't that many 10 years ago who were ex-fossil fuels, but there's been a lot of innovation in the market, and that's come with the growth of the funds. But some investors are proactively, seeding new types of funds that are fossil fuel free, or maybe proactively investing in environmental solutions. So to Tim's point, the size of that opportunity set is growing. And many investors are kind of facilitating that growth if they're not finding.
Mention some of the big names that like BlackRock or.
Yeah, so there are, as Nathan mentioned, there's a BlackRock fund that the National Resource Defense Council funded. There are actually just a couple of our clients are in the process of thinking about this, so they've reached out to the managers in their portfolios and talked about it. So I think there's a lot I think there's a lot of kind of in process, but I think that this market is going to grow, and I think there will be more attractive investment opportunities in the future.
But we don't have much of a track record with many of these new vehicles yet. Someone in the audience says Morgan Stanley recently invested $100 million in Blue Wave Capital, a large solar development in Massachusetts Community Solar. Is that an example of the kind of investment that we should be watching for?
That kind of thing, yes, definitely solar, wind, biomass, all that, that's very interesting. And now, again, that might be a direct investment that Morgan Stanley made, but you might be able to identify for the BU endowment or other endowments funds that do that. And so you have a diversified fund of different wind farms and solar farms, et cetera, to kind of spread out the risk of doing just one different project. But yeah, that kind of investment is definitely.
Anybody else in the audience? Yes. We'll get you a microphone here.
Oil prices in the futures market, how do you think that's affecting the process of divestment? And also,
move the microphone a little closer, please.
Can you hear me? Yeah?
Yeah.
So, yeah, with the new paradigm in the oil futures market, where the oil prices have slumped so low, how do you believe that's affected the process of divestment? Also with the new development of fracking, how do you think those new technologies or new situations will affect this?
Nathan?
Yeah, so I was just reading today, Exxon just released their most recent report, and for the first time in, I believe, 22 years, it was not profitable for them to replace with new reserves, proven reserves, the amount that they sold last year. So this is an indication, first time in 22 years, things are changing in oil. There's a geopolitical component to it, which is basically, keeping prices low, by keeping oil on the market. So consumers are saving, but it's a terrible time for investing in those areas. And, with Exxon, and it's lost. I think they were able to recover like 60 or 67% of their proven reserves. First time in 22 years, they have not been able to come up to 100%. And their entire business model is predicated on replacing reserves with new exploration and new booked reserves. And so, changing that business model when it's predicated on exploration of new reserves, I don't know how they're going to change their business model, but it's a problem for them.
Nathan, let me just press you on that a little bit. Not every barrel of oil is equal in price to pull out of the ground. There are resources and reserves that you can't pull up at $30 a barrel that you can pull up at $100 a barrel. How does that factor in here?
Well, that's caused ExxonMobil to have to explore in some of the most politically dangerous and unstable parts of the world, including Angola, Kazakhstan. Their experience in Chad was very bad. Their experience in Indonesia, Sumatra was very bad. But because they have to go, the business model is predicated on ever increasing proven reserves to replace what's been sold and burned. They're forced to do that. They have been counting the SEC had rules that wouldn't allow them to record some of the dirtiest fuels, including unconventional fuels like tar sands. They include it anyway. That they just do that so that it makes their value higher. So it's a problem for them. They're running out of easy places and safe places to book new reserves.
All of you will have a chance to talk with our guests further after we end up here, and we're a little bit after 8:30. I wanted to wrap with a question again for every member of the panel. Several members of the advisory committee are here in the audience tonight. What would be your advice to them as they address this issue? Nathan, I'll save you for last. Tim?
Well, I think we've all spoken about, and in the room, there's this tangible sense of the urgency of the work that the committee is doing, the importance of it, and the importance of the voice and an institution with the stature of Boston University engaging in the climate debate. I have said before that I didn't think there was just one way to do that, but that sense of urgency should lead to a multiple set of ways in which the university thinks that it can make a significant statement about climate change that will be heard not only in the academic community but more broadly as well. So that's a 10,000-foot goal. I think it's hard for us to make any specific recommendations not knowing the details, as we said before, of how the portfolio is structured. So we could talk about things like voting proxies and so on, but it's without a context for us to speak to.
Noelle, any words of wisdom for the committee as they move ahead with their job?
Well, I just think you're doing a very thorough job, and I would just encourage, that to continue, then to kind of think about everything that's been discussed and use it. Obviously, there are many ways to make, good financial returns and have a positive impact. And so I think it's just important to consider all of them.
And Nathan, you've been part of this process for a good long time now.
Yeah. Well, I want to thank the committee for taking this issue so seriously and giving it the time that it deserves. And I would just say I can't help but address the committee, plus primarily the students in our room, and to say that let's not allow ourselves to let cynicism about our future creep in to where we say that, what we do doesn't matter at BU because the market's just going to do something else. We're not that invested in it anyway, so it really is of no consequence. And so I want to just end with, Margaret Mead's quote, which is, "Never doubt that a small group of thoughtful, committed citizens can change the world." And I hope that the committee, a small group of thoughtful, committed citizens, takes that seriously and, and gives that message to the students on campus. And, Martin Luther King, did he listen to anyone who said, what you're doing, let's look for incremental change. You're just one person. He didn't listen to that. And it started a movement that really made a difference. And I think we can do that. I'm so proud he was here. I'm so proud that Boston University has so many firsts in social justice. And I hope that BU does the right thing on fossil fuel divestment.
Nathan Phillips, Noelle Laing, Tim Smith, thank you.